I'm not going to knock anybody anywhere for saying the Fed may raise rates one more time this year, so that's why the market is down 8%. I think that's not the case, but we can disagree. That may be the fuse, but it's the options activity that I believe is causing these huge swings and big volume jumps. If I'm wrong, please tell me I can handle it. What's going on under the hood?
No, I mean, I think that you're right. I think that, everyone's talking about gamma, right? The option positions when they need to be hedged that exacerbate the moves, the very near-term swings. Now, why is the S&P down 12%? Or why did it correct 12% peak to trough? Why was it down 5% in January? That's not because of the options, and that's not because of the gamma. What the options are doing is they're leading to more very near-term swings and exacerbating near-term moves. So the intermediate direction is not as much impacted by these short-term options, because remember, they expire within a couple days. The ones that are having the most impact are expiring within a couple days. They're not having a lasting impact. But the choppiness, the intraday moves, that the options are clearly having an impact on that. Volatility is higher in general. When volatility gets higher, naturally liquidity decreases a bit, and that becomes somewhat of a negative feedback loop between the two of those. And then you just have some larger near-term option positions, whether it's because of earnings or hedging or anything else. So they're all having a big impact on the very near-term swings.
And do we have any indication of which way most of these options participants in these big name stocks want the stocks to go? Are they put buying? Are they call buying? Or they don't care? They're just looking to profit from the volatility itself.
Well, it's a mixed bag. If you were to ask me that question in 2021, I would say most of this is playing for the upside. We saw a lot more call activity, especially the odd lot, small lot that we kind of more toward the retail trading. Small lot premiums, it's down about 50% from peak GME levels. That was when all the focus was on the calls. We're actually seeing with the OCC data recently, new highs in opening small put activity. So it's not outsized on the puts. It's a little more even, and it just depends on the stock. But if you're looking at Amazon, for example, sentiment got so negative yesterday with Facebook. You saw a lot of people, taking positions in Amazon. You saw a lot of trading going on. And then all of a sudden, Amazon has good earnings and it bounces all the way back. And that kind of speaks to the intraday swings. Not only are we seeing the intraday swings, we're seeing some of the largest overnight moves that we've seen in a long time as well.
And is that because, at least with the S&P 500, the liquidity, believe it or not, is terrible? I mean, the worst in 2 years on many metrics.
Yeah, I mean, that's definitely not going to help. Now, the market's also selling off more than it has in 2 years, and volatility is high in 2 years. So there's just a clear relationship between the liquidity and the volatility. When markets are making bigger swings, and when you're expecting bigger swings every day, things are going to widen out and things are going to thin out, and that's kind of just natural. And it goes back to that feedback loop a little bit. We're going to have to wait to see till we're starting to see some volatility sellers come in. When that becomes more consistent, maybe we start to see a cap on the volatility, the cap on the swings a little bit, and we start to return back to normal a little bit there.
Is there any macro trade that you can see right now with your options crystal ball, Chris? In other words, are people betting that, the S&P or the NASDAQ is going to boom, or that, the Chinese market's going to go up? Is there any directional indication that you can give us on a macro level?
Sure. I mean, you mentioned the Chinese market. We have seen consistent bullish flow in, ETFs like the FXI and the KWEB the last couple weeks now. I mean, the rebound hasn't really happened. There's been a couple kind of false starts there, but investors do seem to be focusing on China outperforming this year. I mean, if you think about it, if we're really, really focused on central banks and the Fed, it's getting a lot tighter here. There are signs that it's loosening out there. And if that's what drives markets, and it has for a while now, maybe this is finally the year that China outperforms. We're definitely seeing some of that there. Yesterday, when the S&P was selling off pretty aggressively, right at the end of the day, we did see a large bullish trade in the SPY, very near term, just about a month out, looking for a rebound back to the levels that we started this year. That was just one trade. I mean, the trades really are all over the place. We've been trying to pick through them, but we are seeing that trend in the China stocks for sure.
Wow, a bit of a bullish move. Maybe it has something to do with Olympic optimism. Who knows? Either way, any advice for our viewers for next week, Chris? What should we be set up for?
So the typical, peak to trough correction for the S&P is about 15%. We've had about 12%. Obviously it'll be more or less depending on whether there's a recession, what the Fed's doing. If it was up to me, I would think there's probably still a little bit more to go with this. I do think that volatility is pretty high. So, if you think we're going to have another 5% or so from here lower before this whole thing shakes out, I would prefer to look at a put spread, 1 or 2 months out. You're not paying as much in implied volatility, and you're taking advantage of the fact that those downside put options, which you will be selling in a put spread, are relatively bid up.